For the past 12 months, central bank monetary policy and fiscal policy has been all about doing whatever it takes to ensure recovery and avoid a major deflationary event. Along the way, this has morphed into an opportunity to get unemployment below full employment levels, or NAIRU, to boost wages growth and lift inflation above previous target levels. But it's not just near zero cash rates and 8 to 9 trillion worth of bond purchases and fiscal stimulus that has helped achieve this quite astonishing recovery. It's also been about forward guidance. Forward guidance has played a significant role in our view, repeatedly telling markets, businesses and households that policy would remain at emergency levels until 2024, in most cases, 2 to 3 years away, has also been a key support for the economy. However, with the stronger than expected recovery and recent high inflation readings, together with expectations of even further strong growth ahead, and unemployment actually breaching full employment levels as early as 2022, the Fed and indeed other central banks risk their credibility if they maintained the emergency stance. And so the Fed has responded last week. Other central banks have already moved to tighten at the margins, and the RBA is likely to move in a similar direction in the coming month or so. So hikes are being brought forward and tapering is now back on the menu. What we're looking at just there in front of us in terms of the chart, we're just looking at the output gap in the US. And based on our expectations, we think that the US economy is going to be operating about as much as 2% above potential GDP during the course of 2022. So this response by the central banks has clearly created some turbulence in markets. And the way we tend to view it is that not just the Fed's move, but also what we're likely to see from the RBA is more of a tapping of the brakes rather than taking away the punch bowl. And yes, markets, and indeed, I think some assets in particular, have been priced off the belief that interest rates, cash rates would remain near zero until 2024. Now they are adjusting to the idea that perhaps cash rates might be near zero until 2023. And of course, the risk is that that is brought forward even further. So the other key factor to keep in mind, though, is that, of course, if markets become more confident that rates are going to remain extremely easy, even if it's for a shorter period, as we're seeing at the moment, it makes it more likely, therefore, that the central banks will eventually be forced to bring forward policy tightening. So that certainty of very close to zero cash rates, even if it's only for another 12 to 18 months, is likely to also support activity, as I said, bringing forward the prospect of tightening. So for us, that means that the risks are likely to rise in the quarters ahead, and we could be only a few sort of stronger employment reports away from bringing forward that tightening even further. So now I want to just focus on some of the observations related to the period in which we find ourselves. As I said, our take on this is that the punch bowl has not been taken away. We can argue whether it should be, but it hasn't been taken away at this point. Rather, we like to think of it as I said, a tapping of the brakes, or perhaps the hosts, the central banks, have turned the music down in anticipation of an end at some point in time down in the future. So let's just make a couple of observations. I want to just look first at central banks and what they're doing in terms of monetary policy. The first one I just want to have a look at here. This is just the central bank net easing and tightening indicator. And of course, what's happened over the last few months is that that's turned to basically neutral. So a number of emerging economy central banks have begun tightening, and now we're getting signals from our own sort of developed market central banks that not so much tightening, but pointing to a less accommodative structure going forward. Now that's often important. If we have a look at the relationship between the central bank easing indicator and what's happened to growth, which will be up in a second, we can see that the blue line on this occasion is the central bank easing tightening indicator. The red line is industrial production. So you can see with a lead of about 15 months, it has on global output. So it's sort of starting to tell us a story that perhaps the pickup in growth is close to peaking at the present time. We can also look at that in terms of momentum and risk. And what we're showing here in this chart is, this is a chart of growth momentum. So the G4 growth momentum, the major four economies, just looking at their current ISM PMI readings relative to the last 12 months. And we can see that the blue line, which is on the right-hand scale, is just sort of eased off. Now it's still in positive territory. It's still a very good signal, but it has lost some of its momentum. And typically what happens with that is risk appetite starts to roll over. Again, it doesn't turn negative until growth momentum turns negative, but it is sort of suggesting that we've seen the best period for risk for some time. Now, just want to have a look at a couple of other ideas here, and related to the idea that perhaps we've seen peak in growth momentum. What we're doing here on the table is looking at periods where the ISM manufacturing index has been above 60. Now that's occurred about 5% of the time since 1980. So that's where we're at the moment. The US ISM is above 60. So what we then look at is, well, what's happened to the equity market in the subsequent 6-month period? What have the returns been like from equities? And what we see is that in the subsequent 6 months, equity market returns have been about, on average, minus 0.9%, as opposed to 5.2% in all other periods. If we go out 12 months, now I'm looking at the subsequent 12-month period, what we see, actually gone too far, excuse me, what we see is that the return from equities has been 4.5%, as opposed to 10.9% in all other periods. So it would appear, on at least on the surface there, that you know, a high level of an ISM has been associated with slightly weaker returns in the 6 and 12-month period ahead. Interestingly, though, if you look at earnings growth, this is trailing EPS in the US, it is on average been about 19.6% higher over the subsequent 12 months, as opposed to 7% in all other periods. So earnings growth has continued to be very strong in the aftermath of the ISM reaching such high levels. So why has the equity market tended to put in more subdued performance? Well, it really comes back to what's happening to policy. And if you have a look at this, what we're showing now is ISM above 60. What's happened to the Fed funds rate in the subsequent 12 months? And on average, Fed funds have increased by 80 basis points, as opposed to declined by about 40 basis points in all other periods. So, you know, as one might expect, strong ISM in the past been associated with tightening policy, and that has led to a PE contraction despite strong earnings growth. So does that give us any clues about what lies ahead for equity markets? Yes, we're of the belief that we've seen the best period of returns for the market, but we believe that this probably overstates the negative outlook, in as far as we don't believe that the Fed is going to be tightening. Yes, they're going to signal some tapering on a 12-month time horizon. They might even bring forward the timing of the first hike, but we don't think it's going to be sufficient to produce such poor performance from the equity market over the period ahead. So I also want to have a look at the idea of tapering, and we only have one previous example, obviously, of tapering, and I'm just going to have a look at that now. And so we had a situation, obviously, in May of 2013 where the Fed started to talk about winding back its bond purchases, that is, buying less bonds than they had in previous months. And during that period, the bond market, in advance of any move to actually taper, sold off by around about 100 basis points. You can see that there. What also happened though, equities managed to put in a pretty solid performance, basically continued their uptrend that was already in place. So it didn't really have much of an impact on equity markets, but it did have a significant negative impact on bond markets. What about for other, the Australian market? We had a look at that here. Australian market in a similar sort of story. Coming up shortly. Market, during that bond sell-off, as we saw, that's the taper episode. The Fed funds rate was still steady for another 18 months or so post that. The equity market, although had an initial sell-off, actually continued to rise during the taper tantrum. And then finally, we'll just finish up with just a couple of comments on the first Fed hike and what that has meant in the past. And I'm going to look at events here. And so what we're looking at now is the equity market. And we're picking up the initial Fed tightening, so in each of the previous episodes. So just to sort of show you what's happening here, these are the tightenings that we're looking at, and we're having a look now at what happened to the equity market in the period ahead. And so broadly, so if 0.0 is the initial hike in rates, on average the equity market has probably suffered a little bit over the very short term, but on most occasions, bar a couple, we can see here in 87, market subsequently fell away, as we know, quite sharply. And also in 94, the market was very subdued for quite some time, with bond yields selling off something like 300 basis points. But on most other occasions, the first Fed hike really hasn't set in place a sustained negative impact on the market. Historically, it's been more when the Fed funds rate is approaching what is perceived to be neutral that problems start to arise for equity markets. That's all we have for today. So thank you